Stop looking at the red candle on your screen. What you just witnessed was not a market collapse. It was a regulatory flush. Between 2 o'clock and 4 o'clock Eastern Standard Time on December 31st, silver dropped from $79.25 to $76.12, a 10% intraday crash. The headlines scream panic. The Reddit threads exploded with fear. Retail sellers capitulated by the thousands. But while you were watching COMEX prices crater in New York, something extraordinary was happening 8,000 miles away. At the same moment silver was allegedly crashing, physical buyers in Shanghai were paying $92 per ounce. Not 76, 92. A $16 premium over the so-called global spot price, the largest arbitrage gap in recorded silver market history. This is not a market. This is a controlled demolition with a very specific deadline. Let me be crystal clear about what happened in those final 2 hours of 2025. At 2:45 p.m. Eastern, the CME announced an emergency margin increase of 32.5% on silver futures contracts. This was the second margin hike in 7 days. The first came on December 24th, a 28% increase that caught the market off guard during holiday thin liquidity. Now they doubled down with another massive hike on the final trading day of the year. Why? The official explanation was increased volatility. The real reason has nothing to do with volatility and everything to do with a regulatory deadline that hits at midnight tonight. December 31st is the cutoff date for GSIB surcharge calculations. Global systemically important banks must report their year-end balance sheet positions to determine their capital buffer requirements for the entire next year. Every $1 billion of commodity exposure on their books increases their regulatory burden. So what do? They liquidate. They dump. They flush every ounce of paper silver they can before the clock strikes 12. This is regulatory theater disguised as price discovery. The mechanics are brutally simple. JP Morgan, Goldman Sachs, and HSBC, the designated market makers who control the clearing system, cannot afford to hold large silver positions over the year-end reporting window. Their compliance departments are reading the fine print. Their risk managers are watching the GSIB coefficients tick upward with every contract they hold. So they orchestrate a synchronized dump. Margin hikes provide the cover story. Thin holiday liquidity provides the execution window, and retail panic provides the exit liquidity. It is a perfect regulatory ambush. The dam breaks, the stops trigger, the algorithm cascade begins. 79 becomes 77 becomes 76 in less than 90 minutes. Volume explodes on the downside. The tape looks like a disaster. But zoom out. Look at what is not crashing. Gold holds $2,680. Platinum holds $950. Palladium actually rises 3% on the day. Only silver gets destroyed. Why? Because only silver has the open interest concentration that creates GSIB exposure problems for the dealer banks. Now pivot to Shanghai. While COMEX is melting down, the Shanghai Futures Exchange is trading physical silver at a $16 premium. $16. That is not a premium. That is a different planet. In normal market conditions, arbitrage keeps global silver prices within 50 cents of each other. If silver is cheaper in New York, you buy it there, put it on a plane, sell it in Shanghai, pocket the difference. That is how markets equilibrate. Water finds its level. But that arbitrage mechanism has completely broken. The physical bars are not moving. American dealers cannot source metal. Chinese buyers cannot access Western inventory. The paper market in New York and the physical market in Asia have fully disconnected. They are operating in separate universes with separate price discovery mechanisms. This is the evidence. This is the proof. The system is broken. Let me explain why this Shanghai premium matters more than anything else you will hear this week. Shanghai prices represent actual physical transactions. Real bars changing hands. Real buyers paying real dollars for real atoms. COMEX prices represent derivative contracts. Synthetic exposure. Paper promises were settled in cash 98% of the time. When the paper price crashes but the physical price holds firm, the paper market has lost credibility. It is a broken thermometer. It no longer measures temperature. It just displays numbers that satisfy regulatory reporting requirements. The Chinese buyers know this. The Middle Eastern sovereign funds know this. The Indian jewelry manufacturers know this. They are paying $92 because they understand the alternative is not getting metal at all, at any price. The premium is not irrational exuberance. It is supply desperation manifesting in price. Here's what happened behind closed doors in the 72 hours leading up to this crash. On December 28th, 3 major U.S. bullion dealers, APMEX, JM Bullion, and SD Bullion, quietly suspended online sales of Silver Eagles and generic rounds. Their websites showed inventory available. Their system allowed you to add items to your cart. But when you tried to check out, the transaction failed. Error messages, technical difficulties, delayed shipping notifications. This was not a coincidence. These dealers source their inventory from the same upstream suppliers, who source from the same refineries, who source from the same COMEX delivery system. That system has no metal. The COMEX registered silver inventory, the portion available for immediate delivery, dropped to 82 million ounces last week. That sounds like a lot until you realize it represents less than 4 days of global industrial consumption. The warehouse is empty, the delivery system is frozen, and the dealers know it. So they pulled their offers before the year-end scramble exposed the shortage to mainstream attention. On December 29th, a leaked memo from a major hedge fund desk surfaced on financial Twitter. The memo warned clients that the silver basis, the spread between futures and physical, had gone negative in the front-month January contract. Negative basis means futures are trading below physical. That should be impossible. Futures should trade at a premium to physical because of the cost of financing and storage. When the basis goes negative, it means one of two things. Either the physical market is in extreme shortage or the futures market is being artificially suppressed. In this case, both are true simultaneously. The physical shortage is real. The industrial users are panicking, the sovereign buyers are hoarding, and the futures market suppression is also real because the dealer banks need to paint the tape lower for year-end reporting. The negative basis is the mathematical proof of manipulation meeting scarcity. On December 30th, the clearinghouse default fund utilization for CME precious metals contracts hit 67%. Let me explain what that means, because most people have never heard of the default fund. When you trade futures, your broker posts margin with the clearinghouse. If you default, your broker covers your losses. If your broker defaults, the clearinghouse taps its default fund, a pool of capital contributed by all clearing members to absorb systemic losses. That fund should never exceed 20% utilization under normal conditions. It hit 67%. That means the clearing system, the spine of the futures market, is under extreme stress. Somebody is sitting in massive losing positions. Somebody cannot meet margin calls. And the system is burning through its safety buffers at an accelerating rate. This is not stability. This is a controlled burn before a potential explosion. Now, let's discuss the January 2nd catalyst that everyone is ignoring. January 2nd is the first business day of 2026. On that day, pension funds and institutional asset managers execute their quarterly rebalancing. They sold equities in December when stocks hit all-time highs. They sold bonds when yields compressed. Now they need to rebalance into underweight asset classes. Commodities are the most underweight they have been relative to target allocations since 2008. An estimated $12 billion of institutional money is waiting to deploy into the commodity complex on January 2nd. Where does that money go? Gold is already near its highs. Oil is range-bound. Copper is China-dependent. Silver is the only major commodity that just crashed 10% on year-end technicals, while the physical market screams shortage. That $12 billion finds silver. It has to. The algorithms do not care about Shanghai premiums or GSIB reporting. They just see underweight allocations and recent weakness. They buy. And when they buy, they discover there is no inventory. The COMEX cannot deliver against large buying. The dealers cannot source from refineries. The refineries cannot source from miners. The entire supply chain is frozen at every node. The transfer of wealth from west to east is accelerating in real time. Chinese state entities are paying $92 for physical meta, L, while American retail investors are panic selling at 76 on margin calls and fear. This is the greatest wealth transfer trade setup of the decade. The Western paper market is disintegrating, while the Eastern physical market is absorbing everything at premiums. In 1980, silver spiked to $50 in a supply squeeze, driven by the Hunt brothers. That squeeze lasted 6 months before regulators changed margin rules and crushed the market. In 2011, silver hit $49 in a retail buying frenzy driven by inflation fears of the end European debt crisis. That rally lasted 8 months before JP Morgan's infamous short position and coordinated selling crushed momentum. This cycle is different. This is not speculation. This is an industrial shortage, meeting monetary debasement, T meeting geopolitical hoarding. China is not the Hunt brothers. They cannot be margin called. They are paying with sovereign reserves. And the Middle East is not Reddit speculators. They're converting oil proceeds into hard assets. The supply deficit is not temporary. Mine production peaked in 2015. Recycling cannot fill the gap. And industrial demand for solar panels and electric vehicles is growing at 12% annually. Let me walk you through what happens next week when markets reopen. Monday morning, January 2nd, the pension flows hit $12 billion in commodity rebalancing. Silver is the primary beneficiary. Algorithms start buying. The first wave hits around 9:45 Eastern. Prices spike from 76 to 79 in 15 minutes. The dealers try to supply metal. They cannot. COMEX inventory is gone. Refineries have 8-week lead times. The dealers go bid only. No offers. Just bids at rising prices, S looking for supply. By 11 a.m., silver hits 82. The Shanghai premium narrows to $8 because Western prices are finally catching up to physical reality. But the real move comes in the afternoon. Around 2 p.m., when European markets close and American institutions finish their month-end purchases, the short sellers who orchestrated the December 31st dump realize they are trapped. They sold at 79, NY expecting to cover at 70. Now it is 82 and rising with no available supply. The squeeze begins. Vertical. 82 becomes 85, becomes 88 by those. The overnight session gaps higher. Asian buyers push it to 91. By Tuesday morning, 95. The clearinghouse raises margins again, but this time it backfires. Higher margins do not stop the rally, they accelerate it. Because physical buyers do not use margin, they pay cash. And the short sellers who need to cover are the ones getting crushed by margin calls. The systemic reality that nobody wants to acknowledge is that the COMEX silver market has become a casino completely disconnected from the physical commodity it supposedly represents. 98% of contracts settle in cash. Only 2% demand delivery. That worked fine when the warehouses had inventory. It worked fine when arbitrage kept global prices aligned. It worked fine when retail and institutional players believed the paper price reflected supply and demand fundamentals. None of those conditions exists anymore. The warehouse is empty. Arbitrage is broken. And the credibility gap is widening every day. When Shanghai trades at 92 and New York trades at 76, the market is screaming that one of these prices is fake. Logic says the physical price is real and the paper price is fiction. But the entire Western financial system is built on the assumption that paper prices are legitimate and physical premiums are anomalies. That assumption is dying. And when it dies completely, the revaluation will be biblical. History is being rewritten in real time, and most people are too focused on the red candle to see it. The December 31st crash will be remembered as the final shakeout before the real move. The last time the banks could engineer a dummy was by using regulatory deadlines and thin liquidity. After January 2nd, the game changes. Institutional flows overwhelm dealer supply. Physical shortage becomes mainstream narrative. Shanghai premiums prove the paper market is irrelevant. And the squeeze goes vertical in a way that makes 2011 look like a practice run. The people who sold at 76 will spend years regretting it. The people who bought the dip will be positioned for the greatest commodity trade of their lifetimes. Let me address the psychological component because this is where most retail investors fail. You see a 10% drop and your brain screams, danger. Red candles equal bad, green candles equal good. That is how you have been conditioned by decades of chart watching. But in broken markets, the opposite is true. The crash is the opportunity. The panic is the gift. The margin call liquidations are the transfer mechanism from weak hands to strong hands. The Chinese buyers paying $92 are not stupid. The Middle Eastern funds accumulating physical assets are not confused. They understand something that Western retail has forgotten. Price is a function of supply and demand. And when supply disappears, price must rise to ration the remaining inventory. The December 31st crash was an artificial supply created by regulatory deadline selling. That supply is gone now, exhausted. The GSIB reporting is done. The year-end books are closed. And starting January 2nd, only real supply and real demand matter. There is no real supply, and there is enormous real demand. Any dip is a gift. That phrase has been repeated so often in precious metal circles that it has become a cliche. But cliches become cliches because they capture fundamental truth. Silver dips below $80 are gifts, not because of hope or belief, because of mathematics. Industrial consumption runs at 1.2 billion ounces annually. Mine supply delivers 830 million ounces. Recycling adds 210 million ounces. That leaves a 160 million ounce structural deficit every year. That deficit gets filled by inventory drawdown. But the inventory is nearly gone. COMEX has 82 million ounces registered. The London bullion market has an estimated 250 million ounces in allocated accounts. Even if you assume both those numbers are real and deliverable, which is generous, that is 330 million ounces of visible inventory against a 160 million ounce annual deficit. Less than 2 years of coverage. And that assumes zero increase in demand, zero monetary buying, zero panic, zero geopolitical accumulation. Those assumptions are delusional. The machinery of the exchange cannot handle what is coming. The COMEX clearing system was designed for a world where 2% of contracts demand delivery. When that number hits 5%, the system strains. When it hits 10%, the system breaks. We are approaching 10%. The December delivery demands overwhelmed the available inventory. The dealers had to source metal from refineries at premiums. The refineries had to pull from industrial allocations. The industrial users started hoarding raw material. The miners started keeping production off the market. The entire supply chain is freezing at every link, and the January contract is even larger than December. 38,000 contracts representing 190 million ounces of silver. If even 8% demand delivery, that is 15 million ounces. COMEX has 8 million available. The math does not work. Something breaks. Either the exchange defaults on delivery obligations, or the price spikes to ration demand, or both happen simultaneously. The banks have lost control. That is the headline they will never print, but everyone can see. For 40 years, the bullion banks controlled precious metals prices through futures market concentration. They held the largest short positions. They set margin requirements. They determined delivery standards. They were the market makers, the warehouses, the clearing members, and the regulators all at once. That vertical integration allowed them to suppress prices during quantitative easing, keep gold and silver contained while they printed trillions. It worked until it stopped working. The Shanghai premium is evidence that they lost control. The negative basis is evidence that they lost control. The COMEX inventory collapse is evidence that they lost control. And the December 31st flush is evidence of desperation, not strength. Strong markets do not need emergency margin hikes on the year-end close. Strong markets do not trade at $16 discounts to physical. Strong markets do not see clearinghouse default funds at 67% utilization. These are symptoms of a system in failure mode. Get some rest. On January 2nd, when institutional money flows into a market with no inventory, you will watch price discovery happen in real time. The suppression dam has disintegrated. The arbitrage gap is proof. The Shanghai premium is proof. The dealer suspensions are proof. The clearinghouse stress is proof. The negative basis is proof. Every data point screams the same message. The paper market is dying. The physical market is taking over, and the revaluation has already begun in Asia, while the West is still watching COMEX tickers. By the time the mainstream financial media figures out what happened, silver will be trading north of $100, and the $16 Shanghai premium will be a footnote in the history of the greatest commodity squeeze of the modern era. The rules are being rewritten this weekend. Make sure you understand them before the bell rings on Monday morning.